This is Richard Flacks at Money Farm with our regular monthly update. We've seen market volatility pick up over the past few weeks, and we wanted to dig into that a bit more. There are a few trends to highlight. The first is rising concern about US economic growth. As we've said before, the US has been the engine of growth over the past 18 months or so, far outstripping the UK and the Eurozone. But some of the latest macro data has pointed to a bit of a slowdown. We've seen weaker than expected results in retail sales and the latest manufacturing survey. We think that's been exacerbated by political uncertainty in the US, which we think is beginning to impact consumer confidence. We've seen all of that reflected not just in weaker equity markets, but also in lower US government bond yields. As part of all that, trade policy is very much back in the headlines. For the past couple of months, investors seem to have been in two minds on tariffs. There is a widely held view that higher tariffs would be negative for economic growth. But investors seem divided about whether the US government would really implement higher tariffs, which could weigh on growth and on equity markets, or whether it was just a negotiating tactic and noise. For now, the US looks set to raise tariffs on Mexico, Canada and China, although that could change, suggesting that they're not just part of an extended negotiation. That's caused financial markets some concerns. Another notable trend is the outperformance of European equities compared to the US so far in 2025. We think there are a few things driving this. First, there was some relief that we didn't see the US put up tariffs on European goods straight away. Second, there's some hope that the US administration will push for some sort of ceasefire between Russia and Ukraine. That could translate into an easing of sanctions and maybe lower energy costs for European companies. Third, the prospect of lower policy rates could also help improve the growth outlook for Europe. And finally, as we've noted before, starting valuations in Europe are generally low compared to history and compared to the US equity market. The geopolitical winds have also been shifting. The US looks set to reduce its commitment to Europe, and it seems clear that defence spending in Europe is going to rise. It's timely that the new German government, when it emerges, will look to increase its investment spending, taking advantage of its low debt levels. Other European countries might find it tougher to follow suit. But overall, we should still see more government spending in Europe going forward, and that should help drive growth. So where does this leave us? On the one hand, we've seen a tough few days in markets, but that's part and parcel of investing and something that we should expect. At the same time, the macro outlook in the US has deteriorated a bit. We'll monitor that closely to see how it can impact corporate earnings growth at a time when valuations for US equities are already high versus history. The outlook for European growth, however, looks a bit better, as European governments see the need to increase their spending at the same time as policy rates seem to be coming down. Thank you for watching and look forward to speaking to you again soon.